The following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market updates and trading strategies. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the Option Block. With your host, Mark Longo from theoptionsinsider.com and co-hosts Mike Tusaw from KnowYourOptionsInc.com and Mark Sebastian from OptionPit.com. The Option Block is brought to you by Options Express. Don't spend time worrying about your broker. At Options Express, security, stability, and account protection are the most important responsibilities to our customers. Secure account access, enhanced financial protection, entrusted with over $7 billion in customer assets, established financial stability. Options Express lets you trade with confidence. Stocks, options, and futures, all in one account. Trade with a specialist. Visit optionsexpress.com/OXradio to open your free account. Options Express is a member of FINRA, SIPC, and NFA.
Welcome back to This Week in Metals. At least that's what it seems like for all of our recent shows these days. No, welcome to the Option Block. My name is Mark Longo, and I will be your tour guide for this abbreviated journey through the world of options today. We have a skeleton crew, so we're just going to crank through some of the highlights today. I am joined by none other than the man from the mountains himself, Uncle Mike Tusaw from Know Your Options Inc. Uncle Mike, how was your weekend, your silver weekend, shall we call it?
Good stuff. Every day is a holiday, every meal's a feast. And as for today, the workers are few, but I'll tell you what, the harvest is plentiful.
Well, good to hear it. We have quite the harvest in store for you listeners. And with that, then, we're just going to roll right into the old trading block.
The Trading Block.
All right, and on the trading block today, it was a modest bullish day on the street today. S&P closed up 6 points. The Dow closed up 46 points. The old NASDAQ closed up 15, nearly 16 points, and the VIX cash closed down 1.24 points on the day. There was some broad news across the pond with rating agencies turning on Greece and crushing some of the Greece debt out there, so that turned the market a little bit more sour. We were up stronger earlier in the session than we closed the day. But, of course, I know the big news for a lot of our listeners, and certainly for Uncle Mike, has been that apparently the apparent turnaround, or I guess you can call it the end to the selling in SLV. So, Uncle Mike, why don't you detail to us your silver adventures over the past few days?
Well, everything's fine now. Everything's okay. Just kidding.
It's all over. All the selling is done. Everyone's back. Everyone's happy at this 36
Everybody's
level.
Happy again. Yes, there we go. It was quite the adventure this last week for me. One of the things that has kept me in business in terms of the silver adventure, so to speak, is the fact that we have hedged oneself. And by having puts in place, it enables you to stay in the trade longer and keep your long-term sentiment. This is one thing that I've based my entire career on, is the fact that options can be part of the long-term investment portfolio. I don't have people in silver just because I think it's going to go from 33 to 37. I want to make a fast buck. This is a long-term investment. I believe that throughout time, silver will be a good investment for people. However, when you have downturns like what we've had in the silver market this past week, I can remember watching the streaming quotes and looking at the silver futures last Sunday night while watching TV and when the president was doing his news conference, just seeing silver just tank. And throughout the week, it definitely continued. Now, one of the rules that we had going into this week was that 40 was our put option for silver. And typically when an option goes in the money on our collars, that's when the radar comes up, so to speak, where we look to either roll down a put or look into buying more shares or something along that line, because of the fact that we want to support our long-term position. When the market goes up, the covered call stands in the way of the integrity of the long-term position. Reason being, if you're bullish on something, that covered call is a roadblock, and you need to respect that. However, when the markets go down and you're benefiting from put options gaining in value, you need to take advantage of that if you're looking to have a long-term perspective on it. Now, what's silver going to do over the next month or two? I have no idea, and I'll be the first to admit that. But I do believe through the long term, it's going to be a good investment for a lot of people. Obviously, it has to be suitable and match your individual needs, goals, and objectives and all that fun stuff. But when you have pullbacks of something like SLV going from the high 40s to the low 30s, God bless you if you can handle that in your stomach if you're not hedged. What helped me sleep at night this last week was the fact that we had the put in place. So the way with which we adjusted it, we got out of our covered call, and the put option that we had, SLV reached a low of around the 33 level. And so my thought was, okay, I want to roll it down, but I'm waiting for an up day before I actually do that. When we're going down $2-3 a day, and oftentimes more than that this last week, I'm not going to roll the put down because of the fact that you're putting more money on the table by doing so. That's what's known as catching a falling knife, or trying to catch a falling knife in the trading world. So my rule was I want to see it come up at least a little bit before we roll down the puts. So what we did on Friday at the close, probably about a half hour before the market closed, was we rolled the puts from the 40 to the 33 level, got a credit in the high fours, and what we did was we decided to wait over the weekend to allow silver to come up a little bit before we sold a covered call again. Now, we didn't know or have any crystal ball that silver was going to come up at all, but this was one of the risks that we felt was worth taking because of the fact that if something bad were to happen over the weekend, it may have the ability for silver to gap up. That didn't happen. But today, going into the market, silver did gap up, but not a lot, not the whole 7% that it actually went up on the day between Friday and today. But what happened was this gave us the opportunity to actually leg into a collar. So silver coming up about, I'd say 45 minutes ago, we sold a May 40 call. We're long the June 33 put, and we're short the May 40 call option. Now, tomorrow, if silver is at 40, I will be tickled pink and more than happy to roll that call option and tell everyone how stupid I was for selling that covered call. But in the meantime, we're getting some pretty decent theta on that May covered call, and silver's going to have to go up close to 10% over the course of the next 2 weeks for that to actually be a roadblock. So when looking at it, what we always try and do is make sure that we're not questioning the long-term integrity of the position, but on the flip side, we're trying to manage risk while we're doing it. And that is the silver saga, at least for now.
The silver annals continue. And yeah, you're constructing those collars the way the pros like to do it, which is, deferring some of the time decay on the long leg and maximizing all that theta, as you said, on the short leg, and taking those short 40s and taking some nice decay over the next few weeks if that does indeed play out for you. And like I said, if it does explode to the upside, you can still roll, and it gives you a little bit of nuance, a little bit of adaptation, as you could say, to that position. GLD looks like turning around as well. We should just call this, instead of the trading block, the metals block.
Right.
It's been all metals all the time lately. There hasn't been much. There wasn't too much going on in the earnings front today, at least that I was watching. Are you watching any earnings names today, aside from SLV, obviously, is your big holding these days?
Well, and it's what's ironic about it, it's not really a big holding for me. I'd say probably the biggest position that I would say maybe 10% of all of our holdings are SLV. And so I wouldn't call that like it's one of the bigger ones, but I wouldn't say it's the biggest one. So I guess it is a big holding, but not the biggest. It's ironic. It's that I don't want the listeners out there to think that I'm just one of those silver jockeys from the internet that is predicting it to go to 75 in the next week or whatever. But it's just when you're collaring something like this was originally intended to be a boring thing. And well, it obviously hasn't been the case.
Yeah, exactly. And of course, there were a few other developments. The good old City reverse split finally went into action today. And as predicted around the world, volumes dropped precipitously as all the high freak guys just got the heck out of Dodge because this name no longer meets all the criteria that they need to do their fee arb and everything else that they like to do. And of course, the new options haven't even listed yet on City. They're still waiting to list those. So all they have is pre-split options that have been adjusted on the 10-for-1 basis. And we did put on some long 45 straddle positions out there in June before that split. So looking like, as predicted, the vol is picking up a little bit out there, and it is starting to move a little more, which is, for City, any movement is a movement because those high freak guys have kept it pegged at 4.5 for the better part of the last month. The thing hasn't really moved or vacillated much whatsoever. So it'll be interesting to see now, as this has some meat on the bones, as we say, what kind of activity we get out here in City options going forward. But I would pretty easily say that this one's going to be off the most active charts going forward. This one just doesn't look like all the players who are playing in it. And I got contacted by some reporters over the weekend to ask about what this has to do for options and options volume. And I was trying to explain to them the true nature of City option volume and the fact that there was, even though it topped the options charts every day and the volume charts every day, there was very little actual economic activity going on in all those contracts, and it was an interesting conversation to have. I'm not sure if they understood it fully, but there's the assumption that if you see numbers going up, something interesting must be happening out there, and all too often these days in options with some of these names that are attracting some of these new forms of liquidity, that is not always the case. But yeah, that's pretty much. Yeah,
they changed a different game for sure.
Oh, different.
It's like going from, instead of going from offense to defense, it's like going from defense to Canadian football, basically.
Yeah, something like, or going from defense to standing still almost, because the name of the game with so much of this new liquidity is just essentially minimize all economic impact and just capture the arbitrage. And so you're just washing trades whenever possible just to capture rebates. It's an intriguing style. I would think that's a very high-risk style in just being able to execute wash trades or low economic impact trades reliably over and over again is a difficult thing to do. I from an execution perspective, I take my hat off to those guys who can do that on a regular basis and make money on it. It's an intriguing way to make a living. But
yeah, that it is.
Just like the two-saw style. You guys are in and out about every 8 seconds, right?
Yeah. High freak for us is more than collaring silver is high freak for us, making 2 trades in a month.
Oh, there we go. Super high. That's going to do it for today's abbreviated trading block. And we're going to roll right into the old odd block.
The odd block.
And welcome to the Odd Block. This is the part of the show where Uncle Mike and I sit back and discuss just indeed how odd Mark Sebastian really is. And since he's not here to defend himself, we can get into copious detail on that front. But instead of doing that, we will dive into the interesting and or the unusual options activity that's lighting up the tape today. And we're going to kick things off with good old Research in Motion, RIM. RIM closed today at $45 and a penny, down 98 cents. This is the name that does about 92,000 contracts a day. They did about 175,000 today. Obviously, RIM has had some difficulties of late. If you look at the old RIM chart, it's been a straight shot to the downside over the past few weeks with a very large, sizable gap from the 56 range down to the high 40s range. A lot of traders, if you were a premium seller in RIM, and especially to the downside, you took some beatings over the past few weeks. The paper we're seeing coming in today is looking like they're expecting this downside bearish trend to continue. We saw some sizable put flies going up today in RIM. This is following, of course, a bunch of analysts have come out and lowered their price targets on RIM over the past few days as well. So all this paper is kind of piling on to the general negative sentiment that's been swirling around RIM. Let's see, today's paper we saw about 3,500, these are long-term put flies, these are the Jan 2012 put flies, and we saw about 3,500 of the Jan 2012 40 puts going up for about $3.77, and they sold twice as many, or 7,000 of the Jan 37 half puts for $2.83, and then picked up 3,500 of the Jan 35 puts for $2.10. So it netted out to 21 cents a contract. So this was the 40, 37 half, 35 put fly for those of you playing the home game. If the stock starts plunging below 40, this put fly starts to pay off pretty nicely. If it gets down to 37 half, then this really starts to pay off. And it looks like someone, either a long equity holder, long underlying holder, or an outright bearish spec, they constructed this put fly to put on a nice little bearish downside spec or pick up some nice downside protection for a relatively modest price. This was a pretty well-constructed fly, it seems like. 21 cents for all of that downside protection and or spec. Not a bad way to construct this. Have you been watching RIM at all, Uncle Mike?
Haven't been watching RIM too much, but I like this trade if you're bearish on RIM. This is the thing. When you go out longer term in the butterfly world, you can get some pretty nice risk-reward ratios at times. The thing that a lot of people need to understand with the butterfly is that it's very likely, or I would guess, at least I know if I were in this trade, I'd be out of this long before RIM were actually down at the 37.5 level. Oftentimes, a beginning trader may look at the butterfly through rose-colored glasses and just say, oh, wow, I can get 10 to 1 on this trade. I'm doing this one.
Yeah,
and then all of a sudden, RIM's at 37.5, and you're lucky if maybe you're up 30% on the trade or something like that. Probably be up more than that. But nonetheless, you need to be careful when doing these in terms of managing expectations, and that for it to actually be exactly at 37.5 in January of 2012 at expiration, the odds are not in your favor at all for that to happen. Because let's say it go to be exactly at that strike price. However, for it to go down and for you to be able to make money and to get a pretty nice profit on the trade, the odds are better. So I think in looking at butterflies, you really need to have a realistic expectation of doing it.
And that goes for just about any position where we see retail coming in and putting on something like a put fly or some of these other multi-leg strategies, and they put them on and they think in their minds of what they've learned in their education classes. You know, they look at the expiration graph and where the break even is and how much this is going to pay off. And that's pretty much all the analysis and all the management they do on that position. They don't realize that these positions require very active management in order to maximize their return. If you just put this put fly on and let the stock drift down to 37.5, that's not the ideal way to get into this. And we've seen this with other positions we've discussed on the show in the past. The 1x2s to the upside we were discussing in silver recently, or maybe the long straddles we were talking about in City. All these positions require management to maximize. If you were missing out on probably 90% of the returns you could be getting if you were in there, and you don't have to do anything as sophisticated as scalping your gamma. That's a little bit more for the sophisticated end of the spectrum, but at the very least, manage your position, know when the appropriate points are to get out. And like you said, just because you put on a Jan 2012 position doesn't mean you have to hold it until Jan 2012. Some of the mindset out there is, oh, I purchased all of this premium, I bought all this time frame, I want to maximize my time that I purchased, and that usually is a backwards mindset. If your position is paying off and this is the time to get out of it, close it out. You can always put it on again, roll it to a different month, a different strike. That's not a difficult thing to do. And look at Uncle Mike. He's been rolling silver nonstop for the past few weeks.
That's true.
So, yeah, and if you don't have the time or the inclination to do that kind of management, then maybe you should call somebody like Uncle Mike who will gladly forego all of his bathroom breaks to do that position management for you.
I go to the bathroom during the day.
Oh, okay.
But by gosh, if I have to take the laptop with me, I'll take it with me if we need to get it done.
I was setting you up as a dedicated man who has nothing but a bottle at his desk and is just at the screens all day long, and you just blew that out of the water for me. So there we go. I was trying to paint a nice impression of you for all of your potential clients out there, and you shot it down, sir.
Well, if I don't know. Do you want your financial advisor with a bottle at his desk? Is that a pretty picture? I don't know if it
Perhaps
is in
not, but it does paint a picture of dedication. Maybe I don't want to shake his hand at the end of the day, but he's getting the job done for me.
There you go.
All right. And then we're going to move on to H&R Block, good old HRB. This one's been on our radar for a while now. We've talked about it on several recent shows, and this one closed at $15.93, down $1.31 today. This is the name that does about close to 7,000 contracts a day. This one did nearly 30,000 today, and this was, just like RIM, this was predominantly bearish paper. Apparently there were some reports circulating that a defunct or a previously defunct subprime lending unit of H&R Block was going to be forced to buy back billions of dollars worth of failed mortgages. And as you can imagine, that is not exactly a bullish rumor. That sent the stock on a nosedive. It was down nearly 8% today. Of course, not surprisingly, the option paper was bearish as well. We saw, it looks like the overall, let's pull up the stats here for the end of the day, but it looks like at one point during the day, it was nearly 30-1 puts versus calls on the day. People were not playing with calls very much at all today. Ended up closing about 16-1 put to call, but still was just a very, very active bearish day for H&R Block. We saw the May 16s, not surprisingly, those puts were pretty active. We saw about 7,000 of them going up by the first half of the session, and towards the end of the day, we saw another about 1,500 or so go up, so a total of about 8,500 of these May 16 puts going up on previous open interest of just a little over 600, so a ton of opening paper coming in. The bulk of these are picked up. They were purchased for about, looks like about 35, 36 cents, so some opening bearish paper in there. We also saw new activity coming in on the May 15 and May 14 puts were about 3,000 of the May 15 puts and about 1,500 of the May 14 puts went up as well. We even saw some really bearish speculators pick up a couple hundred of the May 13 puts as well. So yeah, a lot of front month downside speculating going on here in RIM. This is following on the heels of some bearish paper we saw back in early April when about 5,000 of the May 17 puts were picked up for about 55 cents. Those traders are looking pretty good right now. Those puts are trading about $1.20 right now, so those in-the-money puts are looking pretty good. And of course, the bearish activity was not limited to May. We also saw some activity rolling out to June, where about 7,000 of the June 15 puts changed hands on a previous open interest of 90 contracts. So yeah, a lot of opening paper. The bulk of these puts were purchased for about 53 cents. So a lot of opening bearish paper coming in. Of course, June is an earnings month. They have earnings on the 8th in H&R Block. So these are also in June an earnings spec, but just tons of opening bearish paper coming to play today in H&R Block. And obviously we talked about this name before in the past, and Uncle Mike, I know this isn't one of your holdings, but were you watching any of this paper going up today?
No, this is one where it's not making. I like H&R Block and what they do for people, but I mean it makes me kind of. I hope it works out for them. I guess that's all I have to say.
Yeah, when a name like H&R
works out for them.
Yeah, when a name like H&R Block is getting crushed so heavily into tax season, which should be their strongest quarter of the year, then things aren't looking that good. Of course, who knew they actually had a defunct subprime lending unit?
Yeah.
It's amazing the length that those tentacles of the subprime crisis reached into. Even in your tax planning and advisory services, they had activity in the subprime lending sector. So not surprisingly, the vol spiking up today on H&R Block in the front month to around 44%. So like we said, opening bearish paper in both RIM and H&R Block today in the old odd block. And that's going to do it for the odd block section, and we're going to roll right into Around the Block.
Around the Block.
And welcome to Around the Block. This is the section of the show where we talk about what's coming up on the upcoming sessions, and of course there still is a lot of earnings to be parsed and dealt with. We're seeing good old Uncle Mike's favorite, Cisco, coming up after the close on Wednesday. And I know you've been very active out in Cisco these days. What do you have on going into, what are you positioning ahead of earnings in Cisco, Uncle Mike?
Well, like I've said before, it's a longer-term holding. And initially, this is one where we're not hedged to the downside and that we will hold it. We will buy and hold Cisco. But right now, for a lot of people, our basis is the 19 level. So we're behind a little bit on it, but we have the 18-19 May 1/2 ratio spread combined with the stock. So basically, between 18 and 19, we'll have double leverage. But we don't get to participate on any of the upside past 19. So it's kind of like a covered call position on steroids, basically. And once earnings are over, we'll see where the stock's at. Likely either just let that one sit and get called out if it's above 19, or if it's below 19, depending on how low it goes, we may make some other type of adjustment.
Doing a nice repair strategy to improve that basis, huh?
Pretty much, yeah. So if we're above 18, we're in some pretty good shape on the overall position, and we'll just continue to hold it.
Yeah, we're active in Cisco as well. Not too much. We've closed out a lot of our positions. I think all we have left now is just some shorts on the 17 strike going into earnings, and so we'll see how that plays out. I believe the short 17 puts. We had some short downside put spreads as well, but we've since closed those out. So just some shorts on the 17 strike, and I agree. If it does dip down there, there's a lot you can do with Cisco below 17. A good name to be playing with going into earnings, some nice vol, some nice premium, some nice vacillations, all the things you want going into some earnings if you're looking to trade some vol. And then, of course, we have Disney coming up after the close tomorrow, and then we have Activision. Actually, right now, Activision's earnings already came out, so we should do a quick update to see what's going on in good old Activision. They are, of course, the makers of a lot of electronic entertainment stuff, including probably that Call of Duty game that all the kiddies love to play. And looks like their numbers came out and they're mildly bullish. So our positions on the 11 strike out there are looking pretty good. And then we have crude inventories coming up on Wednesday, of course, as well as good old jobless claims and PPI on Thursday, and the mother of them all, CPI, coming out on Friday. So, that's pretty much what we're looking at for around the block. Earnings and the good old economic calendar. Not too much else going on. We obviously saw that implosion of the skew, the upside skew in SLV. So we'll have to keep an eye on that to see maybe if this upside rally continues in SLV, if they get some of that skew starts to filter back in. I didn't watch it in the upside today. Are you seeing any of that upside skew starting to get strong again in SLV, Uncle Mike?
Not as much as I had hoped. June premium is a little bit more pricey. For right now, though, it was very difficult for me to sell the May. I wanted to sell the June, but just because the premium was very attractive but over the months with which I was looking at for the nearer term, May, June, or July, June appeared to be the most attractive in the call levels that I was seeing. But the skews that we had a week ago or a week and a half ago or whatever it was, nothing like that. But we will see.
Yeah, I mean, just to give you listeners some frame of reference, we were talking about the May 60 strike being a quarter bid a week ago, and now the June 60s are at 8 cents. So that'll give you some frame of reference for not only how much the SLV has sold off, but also how much that skew has just collapsed to the upside. It's like the big winners were the sellers of those, the people who hit those quarter bids on the 60 strike in May.
Yeah.
If your margin allowed it and your brokerage house allowed it, that was a risky but nonetheless profitable trade. And,
very much so.
And of course, that's what you guys do all day and know your options as well, right? You hit the teeny bids out in the wings.
No, not exactly.
That's pretty much going to do it for this Around the Block segment. And that's also going to do it for this episode of the Option Block, this abbreviated episode, if you will. I want to thank my partners in crime for coming on the show, starting and ending with you, Uncle Mike. What is coming up over at Know Your Options, Inc. this week?
Blood, Sweat, and Tears. Physicians Express, St. Charles, Illinois. Stop on by this Saturday. 10 a.m. to 2 p.m. Give some blood. Bring the kids out to the Jumpa Jumpa. I will be there, and just give some blood. It'll be a fun time. It's at the corner of Route 64 and Randall Road in St. Charles. Stop on by and give some blood.
And, of course, this is a very active week for us over at the Options Insider. Of course, this is the week of the big Options Industry Conference, so I will be heading down to Savannah in a couple of days where we will be doing another one of our big audio blowouts down there. And if our listeners are new to the show and new to the Options Insider, every year we go to the OIC show and we put on, not only do we feature all of the panel content from the conference, so if you can't make it down to Savannah this year, don't worry, we will be featuring all of that panel content after the conference is over, and we will also be doing quite a few of our flagship shows down there, the Options Insider Radio Show, and we'll bring on all the heads of the brokerage firms, all the heads of the exchanges, all the heads of the vendor firms and the trading firms, and we'll have them come in one after another, and we'll just sit them down and we'll pick their brains a bit about what's been going on in the options market, in the options industry. If you're interested at all in options, then this is the content for you. Every year, this is always top of the chart stuff for us. In fact, I looked at the numbers the other day, and our content from OIC 2010 was, I think, still in our top 20 downloads for that day, like number 8 and number 14. So people love this content. People love to come back to it. It always does very well for us in iTunes, and it's very interesting. Of course, for me, it means my experience of Savannah will be in a room for 3 days recording, but it's always worth it at the end of the day because we get some fantastic guests. The entire industry just parades by our desk for 3 days, and we have some really great guests. So stay tuned to the Options Insider. Stay tuned to our Twitter feed. Stay tuned to our radio section. Stay tuned to our Options Insider radio feed in iTunes. We will be putting out an explosion of content over the coming days and weeks. So look forward to that. And I'll also give a plug.
Great stuff, folks. Yeah,
it's fun. It's a big undertaking for us. We have to bring the whole crew down there and set up and arrange all these interviews and all these guests and all this recording. And every year I'm always saying to myself, this is the last year we're going to do it. But every year we do it again because it's fun and the audience just loves it and devours it, and quite frankly, there's no one else out there who does this, so it's kind of our thing. It's unique to us, and the audience loves it, so we don't mind doing it every year, though maybe after the end of this week I might take a little nap for a few days. And of course I should give a plug to our comrades who couldn't make it on the show today. Good old Mark Sebastian over at optionpit.com. Surf on over there, check out the deals he has going on for his classes, and of course go surf on over to optionsexpress.com/OXradio if you'd like to get some free trades and try out all the stuff we've been talking about, all the technology and the systems we've been talking about over at OX over the past 58 shows. And I want to thank, hard to believe it's been 58 shows already, hasn't it, Uncle Mike?
Unbelievable.
It's crazy. We're closing in on that big 75, and there's a good chance we're going to do a big blowout live show to celebrate that event. So stay tuned for that as well, listeners. But that is going to do it for this abbreviated episode of The Option Block. I want to thank all of our listeners for downloading and subscribing and listening to this show and making it such a success. And we'll see you next time right here on The Option Block.
Become a part of the Option Block. Just visit www.theoptionsinsider.com/forum to post a question for the hosts. You can also submit questions to twitter.com/optionblock or leave a voicemail at 312-544-9356. Make it interesting and your question just might make it on the air. The Options Block is property of the Options Insider Incorporated. All rights reserved. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.